Well, welcome to the fun and mentals of real estate. I have a question for you today, and that is how smart investors choose their next property.
All right, I got a question for you back.
All right.
How do I become a smart investor?
Listen to the podcast.
Oh, that's great. You got to educate yourself. And this has really been a fun series for me. I've learned a lot. I'm not big with rental property. Oh, you keep reminding me. I do own it because I help my two kids with houses, and we're kind of in on that together.
Yeah.
But now we're really getting into the nitty gritty, picking these properties because it just seems so confusing, opaque, whatever to me. So I'm excited to learn today.
And a lot of people say, I just feel like it'll be a good deal. And you don't want to do that. All right. So numbers are the language of real estate.
Numbers. And the other thing is that I've learned from you too, systems, or today we're going to call them models.
Models, right.
Right. And there's a lot of people that have come before us to educate us. And I know when you bought yours, you did a lot of work.
Right. So, evaluating models, right? How do I evaluate a property to say, yes, this will be profitable? Remember, you're buying it for profit. Most people. There are some people who buy it only for a tax write-off.
Yeah.
So this is why we talked last week and the last couple of weeks about why you're buying the rental property and what is your goal in purchasing it. And then how you're going to buy it, if you're going to have a loan, if you're going to pay cash, how much money down do you need, which we explored last week of the DSCR loan. You may need 20 or 25% down. And so
there's some people we talked about that they're using this, they have cash and they just want to use cash. There's so many, and there's almost, I want to say it's not infinite, but there's a lot of different models. And thankfully you've kind of pared it down to the 3 or 4 that make the most sense.
Yeah, let's talk about a few real quick here. All right, so the easiest one, and the one that I use because I like to pay cash for rental properties, all right? So I don't have the whole loan thing I have to mess with. But the 1% rule, even with a loan, can be very helpful in initially screening to see if you need to go view it, look into it further, spend your wheels, your time on the property. And the 1% rule is just this. If whatever I buy the property for and I invest in the property, so new flooring, put a new furnace in, right? A repair, whatever I'm totally into the property for. So let's just say I bought a property for $230,000. I put 20 in it. I'm $250,000 in it. The 1% rule says I should be able to rent it for $2,500. Right, 1% of all in.
And you tell me this is easy, and I guess the appraisers do it, but I'm confused. Where do I go quickly to find out that? How do I know that this house on this street should rent for about $2,500?
So that's one of the first things you probably should learn. Right. Is how to evaluate what something will rent for.
Right.
And basically, you can use a couple things. One is the rent-o-meter.
It is. Rent-o-meter.
It's a rent-o-meter. It has a green and a red, and it tells you. It's just an app. Just Google rent-o-meter.
That is something that our parents and even people investing in real estate 20 years ago didn't have.
Oh,
we've got Google, we've got AI, we've got all those tools. So there's ways you can go and find out approximately, and the market's going to determine the rent. But this was my biggest hang up, and you did a good job getting me over this hurdle, finding out what that rent's going to be.
Yeah, so rent-o-meter, you can just go look at the moment, what is available in that zip code, in that neighborhood of houses. So first of all, in your models is picking an area. Right. So for me, I'm just going to talk about Baldwin. I like Baldwin. Pick the city of Baldwin. Just get online and see what you can rent a house for. Right. Or a multifamily, a 4-family, a 2-family in Baldwin for how updated it is, how many bedrooms, how many baths. The rent-o-meter, you put in the bedrooms, the baths, the area, okay, and then it's going to tell you about what the range is. I usually like to push the rent-o-meter a little bit and be on the high side of it. And I find out right now, because the momentum is higher, I use the high side of the rent-o-meter. Yeah. But then I also look at, hey, what's my competition? Just like as I was going to sell a house.
Right.
I would go out and I would say, hey, who else has got something for sale? And what are all their perks? How nice are their kitchens and baths? Do they have a finished basement? Is there a garage? Is there a level fenced yard? Right? Who am I renting to?
So that was a big hang up. I mean, I was amazed how easy you got that answer for me.
Yeah, so just get online and then put yourself on a little drip campaign, and we're happy to do this for you too. We can set you up in the MLS because a lot of agents rent homes too. So I go to the MLS and I look. And if you're like, oh, I like these areas, we'll just start sending you every rental property that comes up.
And that's a great
And
point.
then
Since
you
we
just
did the
learn
last,
it. You learn it.
since we did the last podcast, I've had a whole bunch of people call me. What do I need to qualify for rental property? So we forget about it. We're here to educate, but we're also here. Give us a call, get nitty gritty, really look at specifics. All right.
Yeah.
That's a great one. Now I'm going to move
All
on
right.
to the second one. And this is another one that uses terms that
Yeah.
right over my head.
All right. So maybe we'll have some fun.
All right.
But right now, maybe we're going to be a little
All right,
mental.
well-
but it's not too bad. I'm going to break this down for you really easy. It's called a cap rate formula.
And I just assumed that if you had a special cap, you got a better rate.
Okay, great. Thank you, Glenn. Thank you so much. All right, so a cap rate just is a formula. And appraisers use this, right, Glenn?
Of course they do.
Sure.
Appraisers and commercial lenders use this too. And you know, one of my good friends is a commercial developer, so I'm familiar. Capital stands for capitalization.
Yes.
Right.
It's a capitalization rate. So basically what they do is, first of all, this is after you've passed the 1% rule.
Right.
You're like, I want to look at this a little bit closer. Now you need to get all the expenses on the property. As a landlord, do I have to pay sewer? Do I have to pay trash? What's the insurance? Right? What are the
Taxes.
real estate taxes? If I'm going to get a loan,
Right.
what does that mortgage payment
Am I
look
going to
like?
have a management fee?
Am I going to have a management
Trying to think
fee?
some of the
Right?
others.
Do I have common electric?
Yeah.
If it's a 4-family or something, you're probably
Maybe
going to have some
Be
electric.
safe. I'll put a vacancy factor in there. Set aside some reserves for
Right.
expenses in the future.
So
Okay. I've done
you
all
need
that.
to find out your net income. So the total gross rent minus all those expenses is my net income.
Right. And I'm going to divide that by the value
I'm
of the
going to
property.
divide it by the value of the property, which for me is going to be my purchase price.
So it's going to give
Right.
me, to me, it seems like an arbitrary number, but if that number is X,
Is
then it's a
around
good deal.
10%.
So if it's
So
a higher,
most investors want to see a 10% return on their money.
right.
And that's what this is telling you. What is the return on my investment?
perfect.
Okay, that's what it's telling you. So most of them like to see around 10.
And I'm
8 at probably the minimum. They don't usually like much less than an 8.
Right.
But if you can get a 10 or a 12, man, you are looking pretty.
Okay.
So this is delving into a little bit more than just using that easy 1% rule. I screen everything on a 1% rule because I know what it's going to rent for in that area when I'm
So
looking
it's almost
at it.
like filtering. I'm filtering out this,
I'm filtering out, and
that.
then I
Right.
figure out what I can look at more in depth.
And you know, the thing is, just in the time that we've been together, this all kind of mystifies me, but you're so good about bringing it down to the real numbers. What does it really mean? And a lot of it's just common sense.
It is. A
Yeah.
lot of and here's
doing your
another-
homework.
Here's another way I used to look at it when I was very, very first investing.
So
And
let me
this
think, your
is-
first
this is a
investment was a
different model.
2-family, right? Isn't that-
My very first investment was 2-family.
Yes,
I did
that's
live in the
amazing.
bottom and rent top out.
Yeah.
But we bought singles after that.
Mm-hmm.
And the way I evaluated whether I thought that a property was worth buying was this formula. I was getting a loan, and I was only putting down like 5 or 10% at this time.
Right.
This is years ago, by the way.
Good old days.
And so, right, the good old days.
Yeah.
And so I would say I need 10 grand to buy this property.
Okay.
At the end of the day, when I go to sell it, because I was flipping them and I was doing lease purchases, so they would have a lease and a contract to purchase for a year to 18 months, and then they would buy it for a set number.
Right.
So if I said to myself in that year or 18 months, if I put 10 grand in and I got 20 grand back, so I got my 10 back and I made another 10, it was 100% return on the money I pulled out of my pocket to use. I didn't care about anything else other than what I was going to make. How much money was I going to get back? And what kind of
I would assume
return
you
on
have to,
just the
you have to
money
make
I
sure
put in.
that tenant is paying all the expenses, because maybe you did get that 20, but if you still had to pay, that's
Well,
why
he's
you gotta
paying.
do the
He's
work.
paying a rental amount. I mean, the
Right.
rent had to
The
make
rent-
sense.
right.
So the rent was always slightly less. No, slightly more. Sorry, slightly more than if they would have bought it with their mortgage payment, because I wanted them to buy it.
Right.
So that was a different kind of model. Was a lease purchase model. I never had a vacancy because I could lease purchase those babies
Heck
in
yeah.
one weekend. People want to rent to own. It's a great little model if you're willing to just continue to flip properties. We did 1099 exchanges, which means we didn't pay any taxes on our profit. We just rolled the whole thing into the next rental property until we wanted to cash out. So that was
kind
that's
of
a
brings
different
us
way.
into our next model, that value-added model, because
Value-added models are, a lot of people, to do a value-add model basically means that you're going to buy a investment property,
Right.
whether it's a single or multi. You're going to be able to fix it up. You're
Right.
going to be able to improve it. All right, you're
Add
gonna
value,
you're
right.
gonna update
Add
the
value,
kitchen. You're
right.
gonna update the baths. You're gonna update the floors. Something. You're gonna do something that makes that property worth more money. Okay. So now a lot of people use the Burr method for that, right? Buy it, rehab it, rent it, refinance it, do it again, repeat,
Yeah.
right? And so, but that is, you have to look at this differently, because now I'm looking at not just my income and what I can rent it for, but what is that baby going to be worth? What's that investment property going to be worth after I've just stuck 10 grand into it?
Right.
Okay. So, and all these don't really look really super long term. Long term, when you start, you're like, man, I really want to get into looking at rental property and owning a bunch of real estate.
Right.
Well, now there are spreadsheets. We have one. If you want one, I'm happy to send one to you. It's a spreadsheet that not only takes into consideration all my expenses, my
Right.
property management, my taxes, my insurance, all that stuff, and what I can rent it for, but it also then has a built-in model that will model future value of the property in 10 or 20 or 30 years, future rents of the property.
Because the rents are going to be increasing. Hopefully, in a perfect world, those
right.
rents are going to be the value. And think of it this way: is if I have a loan on it, that's not all interest. Part of that payment is reducing my principal. So
That's
hopefully,
right.
this is my loan, and the value has the loan is going down, the value is going up, and that's increasing. And that's that long-term buy and hold, and looking for the passive income when I would retire.
Right.
Or a
Get
bunch
that
of
baby
capital.
paid off in 20 years.
Right.
Right. Let the tenants pay it off, and don't ignore that. So basically, now you also have tax write-offs on this. So, like, I bought a
That's
rental
huge,
property.
right.
I used the 1% rule. I'm good there. And then I looked at what is that property now worth, because I just put about 7 grand into it, some new carpet, new electrical panel,
Which you get to
cleaned
write
it
off
up,
your
blah, blah, blah,
taxes, right?
which I wrote off. And then I'm like, okay, now I bought it under market, so now it's worth more, right? So now I have appreciation.
Yep.
I have a tax write-off.
Substantial, because you're also taking depreciation, not only the expenses you make, but
Right.
because the IRS says that house is going to be worthless in so many years.
That's right. So I
Right.
get to depreciate
Yes,
it on my
that's
tax.
a
So I get
huge,
tax
yeah.
write-offs, right? I get tax write-off, appreciation, and then actual profit. I figured on that particular property, I'm making a 14% rate of return.
Which is more than you were getting in your safe investment.
More than,
right.
yeah. So I wouldn't go into investment property unless I think I could make more in it than a passive,
Right.
that's a passive mutual fund, right? Or, right? Or any kind of a stock fund. And those are easy. Those are very passive.
Yes.
This is very active. Right. This is different. Even if you use a property manager, you still got to figure this out. I mean, no one's going to figure this out
Well,
for
I think
you, right?
the reward is really big on this stuff, especially what we've seen over the last 3 or 4 years in appreciation. I wish I could go back in the Wayback Machine. We talked about it.
No kidding.
Lori and I would have bought 4 or 5 properties 5 years ago. I'd have a lot of equity in those
Right.
properties.
So we're here to help you evaluate
Yes.
how smart investors choose their next property. Again, your motivation, your why, how much money you need to get into one,
Yeah, sure.
why you're doing it. Are you doing
My takeaway
it?
is don't be overwhelmed. Because
Right.
to me, initially, it's overwhelming.
Right.
It's this, I don't understand that. When you break it down, it really is common sense.
Right. But again, the why you're doing it. Is this a long-term investment for retirement?
Right.
Or is this a short-term like some of mine were when I lease purchased, and I would sell them in a year to 18 months, sometimes took 2 years. But I would flip them that way without any vacancies ever. Or like the one I hold now where I just rent out.
Yeah.
So that I just have for passive income now. It's a different goal than when I was younger. When I was younger, I wanted cash. I wanted to.
It's not one
get
size
cash.
fits all.
Yeah, it's
And
not.
the thing is, too, you don't have to invent the wheel on your own. You have professionals
No.
like Angie. If you need the financing, it's me. Educate yourself and see if it is, because there is a great potential to make a lot of money.
There really is. And don't forget to listen to the podcast
Yes.
about the DSCR loan.
Yes, I love that one.
Okay, that we did last week or the week before.
I get a lot of calls
And
about that one.
man, that is, you could have no job and buy an investment property. Again, I just want to mention that because not many people know much about that. There's also great programs to buy with your college age student.
Yes.
Or to help an elderly parent or a disabled
family opportunity loan,
right?
yeah, and get in with your children. That house hacking probably makes the most sense.
Yeah,
to get in
it makes a lot of
quick
sense
and
when
easy.
you're young.
When you're young, yeah.
When
I
you're
learned
young.
so much, and I appreciate your expertise and really debunking and explaining a lot of stuff. Because when I hear blah blah blah, the cap rate, this that, it just kind of flies over me. But when you take a minute to learn, educate yourself, it really is common
and
sense.
it's easy to hone in when you know the why you're doing it,
Right.
right? What's your goal? So figure out your goal. Like our podcast, share it if you can.
Yes.
It'd be great if it helps other people as well. We love
Remind
to
me
help
what we're here to
everybody.
do.
We are here. I am Angela Dillman here at Keller Williams Realty Chesterfield. And this is my wealth building partner.
Glenn Calvin at Gill Mortgage.
And we're here to help you build wealth.
Live your dream lifestyle.
And leave legacies that
and
matter.
maybe buy some rental property.
That's right.
Yes.
Thanks for listening. We'll talk to you next week.